Hello and welcome to episode 17 of Southbank Live, the first of our Southbank Lives that we've been broadcasting in the evening, as that does suit more people than our normal noon slot as we've been going through. My name is Boaz Shoshan, and as ever, I'm joined by John Butler. John, how are you getting on today?
Yeah, doing well, boss. Thanks.
Yeah, we've got plenty of things to discuss this week. It's been a very lively week, as have been several of our past Southbank Lives, actually. But just to start us off is the great debate over whether or not central banks will actually raise interest rates to the point where inflation goes away, something that they are sort of duty bound to do. But whether or not they will do it when push comes to shove is the big discussion. So, John, I mean, we've got plenty of avenues we could walk around. I think we could start with with our reading between the headlines segment here. So we'll just go through some of a couple of the headlines from this week. I think the first one we have is from the FT here, with the headline being "Investors Worry Over Potential Bank of England Rates Mistake. Traders fear policymakers will move too aggressively in their attempts to tame inflation." That's from the FT. And yeah, I think we'll start with that, John, with where we are in the UK. Where we are with the inflation story in the UK. We've seen some very strong statistics out there. Of course, with the energy crisis, that's only compounded it. What's your take on whether or not the Bank of England are going to really stop this? Because getting this right is key for British investors and indeed everyone who owns sterling in general, everywhere.
Well, absolutely. Look, central banks, including, of course, the Bank of England, they can't really ignore what's happening, of course. Inflation has risen by far more than they forecast. I mean, far more. They talk about a big miss, but that's, to be fair, that's true everywhere. So I'm not going to single out the Bank of England,
Right.
but they have missed by a very wide margin now. And if you look at the pipeline pressure and producer prices, if you look at the continued strength in commodity prices, most commodities, not all, it's obvious that there is a lot more inflation on the way. We have not yet seen the peak. And the Bank of England, I'm sure, can see that too. And so they are now facing an imminent crisis of credibility. That is, if they do absolutely nothing,
Yeah.
which I think is unlikely, then it's really not clear what's driving policy, right? They are supposed to meet their 2% inflation target. And so I'm almost certain that they're going to do something at least symbolic to show that they're at least paying attention and that inflation does matter, even if it's not perhaps the only factor that figures in their policy decisions.
When you're thinking of the factors which do influence policy decisions, if you put yourself in the shoes of Andrew Bailey at the moment, the governor of the Bank of England, what is it that's keeping him awake at night? What is it that's worrying him the most and might drive him to act one way or another?
Well, I think Andrew's in good company when you look around, most of the world's major economies, in that the central banks have really kind of backed themselves into a corner by leaving very, very loose monetary conditions in place for an extremely long period of time. And depending on precisely how you look at it, almost doesn't matter. Debt and leverage in the system are as high today as they were going into 2007, 2008. Nobody wants a repeat of that, and yet that's kind of what the data show. Again, you can't time it, a blow up like that. You can't say, oh, it's going to happen tomorrow. But the set of conditions that allowed 2007, 2008 to unfold as they did is not only similar today, but larger today, in my opinion, based on the way I look at these things. And so I suspect that central bankers are extremely nervous. They know they're facing a crisis of credibility. They know they have to raise interest rates or no one's going to take them seriously anymore. But they're absolutely terrified of the sort of unseen bombs out there, landmines hiding within the nooks and crannies of the banking and financial system.
When you're thinking of what that unexploded ordinance is, where would we be looking? What kind of debt would you be looking at as the real dangerous things?
Well, one problem here is that all debt is not created equal. Once upon a time, corporations, and that includes financial corporations such as banks, they issued pretty plain vanilla debt instruments, right? Normally coupon bearing, sometimes zero coupon, sometimes perpetual, sometimes overnight, very short-term funding that was simply rolled over. But it was all pretty generic. And the risk characteristics of that debt could be modeled in a fairly straightforward way. We've come such a long way with the explosive growth of derivatives of various kinds, structured finance of various kinds, hybrid equity. I mean, look, they've come up with just one rabbit after another to pull out of their hat as a means to access leverage in the system. That's true of the large banks. It's true of the small banks. It's true of various other financial intermediaries. It's true of hedge funds. It's true of everyone. And so it's extremely difficult to know. Now, the Bank of International Settlements, with the new Basel III regulations being rolled out and measures of capital adequacy and whatnot, they're trying to catch up, but it's trying to catch up. In no way have they got out in front of this thing, and they admit it. I mean, behind closed doors, they admit it. They kind of know that they've created this beast they can't control, so they do what they can around the margins. But I think they're terrified.
On the topic of central bankers being maybe terrified of this, or just the regime change that's the regime that we're in and how some of the old guard are leaving, I thought it was very interesting today, perfect time for this broadcast, that Jens Weidmann had left the Bundesbank in Germany. We have another headline to show there. I believe this is another one from the FT with, Bundesbank chief Jens Weidmann to step down. Central banker has been vocal critic of ultra-loose monetary policy. So for those who've been watching the European Central Bank and the Eurozone's monetary drama and dilemmas over the years, Jens Weidmann was one of the very few people who were speaking out against a huge amount of the quantitative easing efforts, was speaking very aggressively for rate increases, or at least less interest rate cuts. And being German, of course, they have much more appreciation for hard money than some of the other countries in the Eurozone. But now Weidmann has decided, it's time to call it in. It's time to retire, or at least, time for other things. And it seems like there's sort of an extinction event with hawks amongst the monetary policy community, where the doves are those who love easy money and low interest rates, whereas the hawks want higher interest rates. And of course, we've seen, being hawkish on interest rates has been very, very unpopular for a long period of time. You already see plenty of protests from various academics over in the US saying, no, we can't go raising interest rates too early. But to see Jens Weidmann leaving now seems very symbolic to me, John. What's your take on that? Because are there any hawks that are going to take his place? And is there somebody else that's going to be there actually saying, maybe we shouldn't be printing this much money?
Well, certainly no one at the ECB currently, and that includes both the senior leadership as well as the national central bank representatives. None of them really have his gravitas. I mean, the Bundesbank, by definition, has gravitas. And if you're the president of the Bundesbank, then you certainly have gravitas. And Weidmann has been in that role a long time. And he has a long track record of being critical of multiple major ECB decisions post-2008 to provide various forms of, let's face it, increasingly creative liquidity to the financial system. And I suspect that he has, look, I mean, he's ended up, he's not a politician, but you kind of end up in a political role when you get involved in these sorts of decisions. And I think he's had a very, very difficult job to do. That is to try and represent the Bundesbank and the traditional national monetary interests of Germany. I think he's tried to do that. I suspect, although this is pure suspicion on my part, I suspect he has been disappointed with the German Constitutional Court's unwillingness to be a bit more black and white when calling out the ECB and making the case that what the ECB is doing violates the Maastricht Treaty and also indirectly, therefore, violates the Bundesbank Charter, which reads very clearly what the job of the Bundesbank is to do. It could be now, as a result of the recent German elections, that Weidmann feels it's a convenient time to step down, because it can't possibly be seen as an anti-Merkel statement, and it can't possibly be seen as an anti-anyone statement, because we don't yet know who's going to be chancellor going forward. So maybe he just decided this was a good window to depart the scene, kind of having done what he could do, probably, in my opinion, being disappointed that the Constitutional Court did not more clearly take his side in these disputes. I think he'll remain influential as a thinker. and as an advisor, probably to the future German government, the one that will be formed before too long. But yeah, he cites personal reasons, and I think that's also part of it.
Yes, it does seem like a good time to get out while you can before the German government has sort of appeared and made its policies quite clear. But John, do you think the German hard money initiative has been damaged at all by Weidmann leaving? Do you think this makes it easier for the ECB to pursue more aggressive monetary easing?
Well, I mean, look, Weidmann is hawkish in relative terms vis-a-vis his colleagues at the ECB. And indeed vis-a-vis some of his colleagues, the Bundesbank, but not all. In German monetary terms, Weidmann is pretty mainstream in a historical comparison. There have been people far more hawkish than Weidmann.
Right.
In particular, what you saw with like Karl Otto Pohl, for example, and the period of German reunification, when the Bundesbank famously directly contradicted government policy, which was basically to throw a lot of money at Eastern Germany to help rebuild it. The Bundesbank said, well, okay, you go ahead and do that, but we're going to raise interest rates to astronomical levels to make sure it's not inflationary.
Right.
And West Germany falls into recession as a result. That was deeply unpopular, but hey, I mean, that's what a hawkish Bundesbank used to do, that sort of thing.
Right.
Weidmann has never done anything like that, and yet he hasn't had the power to do so, obviously, because he's simply one member of the ECB's governing council. So there is a hard money crowd in Germany. Some of them are significantly more hawkish than Weidmann. They'll do what they can, I suppose, to have influence over the new government, but it might be fairly minor. Now, that said, Germans think differently about inflation as most Europeans do. I mentioned this before.
Yeah.
Inflation is a much more directly political issue in Germany because of its historical associations with the failure of the Weimar Republic and rise to power by Hitler. And so it's easier to take a high rate of inflation and turn it into a political issue in Germany than it is in most Euro area countries. So it's possible the German hard money crowd is actually going to have a certain amount of political influence if we start seeing, 4%, 5% inflation prints.
Yes, it is interesting that we think of Weidmann as one of the most hawkish central bankers out there, when historically speaking, he's relatively actually quite mild, quite dovish. But that's a sign of the times, I suppose, that we're in at the moment. That the departure of Weidmann is almost like the extinction of the hawks. Now, looking over at the chat, we have got quite a lively chat, which is great to see. A good evening to everybody who has joined us today. We'll start with one from Enderman, which is looking again at the Bank of England, though not so much at the interest rate side. So why did the Bank of England say Bitcoin will cause the next financial crisis? Do they really think that? What are they really communicating here? Now, I haven't actually read the actual speech where this was put about. John, perhaps you know a little more about this than me, but where I believe I did read one of the news articles about it, where it was one of the Bank of England officials that was saying that Bitcoin could cause the next financial crisis because it was unregulated and it was leading to a growth in leverage which was outside of their control. What's your take on that?
Well, look, I mean, it is the mindset of regulators that whatever they don't regulate and whatever they don't control somehow has to be suboptimal, because they're not the ones messing with it, right? Controlling it in some way, making it better. Look, they have a natural bias to disparage anything that arises spontaneously out of a free market and voluntary association between individuals. So now that aside, in this specific case, look, Bitcoin is no small matter anymore. I mean, look at the market cap of it, especially this week, with the price surging as it's doing.
Yes.
And whereas Bitcoin may exist completely outside the existing financial system, the fact is a growing number of individuals, and for that matter, some corporations, have a not immaterial portion of their wealth in Bitcoin, and that may be encouraging them to take on debt, to leverage up, to just think that Bitcoin's going to the moon. There are several corporations out there that have acquired so much Bitcoin and have issued debt to acquire it that if Bitcoin suffers a major setback, they're going to go bankrupt. And they might also have lines of credit with banks, and that will be a hit to bank credit. So I think if you really stretch this a long, long way, you can begin to imagine the possibility that a major Bitcoin implosion could impact the banking and financial system. But it's a real stretch of imagination that I think only a dyed-in-the-wool regulator would see that way.
Yes, when we were speaking about unexploded ordnance in the banking system in terms of the amount of leverage and debt that there is out there, I mean, Bitcoin seems to be, quite removed. There are much bigger risks for
Indeed.
somebody to be paying attention to.
Absolutely.
Does feel like the will to regulate something. I mean, considering the incredible drawdown that we saw just from Bitcoin from its previous all-time highs at the beginning of this year down through the summer, there was an incredible drawdown. So many that traders got liquidated, and yet in terms of the real term impact, nothing actually happened. There wasn't any systemic issues. Just a load of traders lost a boatload of money, and the environment recovered again. So it does make you wonder what is the agenda here when we're hearing central bankers talk about this stuff. Now, another question here we have from Brian. The US is still pumping out enormous loads of cash, no prospect of raising interest rates for a long time. If the US market suffers as a result, it would crash the UK market regardless of our measures. Now, well, I say it was a question, Brian. There's more a comment there from Brian. But John, what would you make of that? So, do you think that the US and their easing efforts, there aren't many hawks over that side of the fence either? Do you think that's going to lead to the US market suffering as a result, and that leading on to any kind of contagion here across the pond?
Well, look, right. If the U.S. sneezes, the world catches a cold, and that's certainly true in terms of monetary policy. If, for some reason, the Fed does eventually get some religion and decides it has its own credibility problem to deal with, and it needs to raise interest rates at least a little bit to begin addressing that. Look, the whole world's going to notice, right? No economy is going to escape, certainly not the UK, which is a small open economy with traditionally very strong ties to the US economy and financial system specifically.
Yeah.
So yes, if the Fed gets in gear here, then that will affect the entire world. And so I think it is worth watching what's going on in the US. But as you say, gosh, right now, I mean, the way the political winds are blowing in the US, it's all about stimulus, stimulus, stimulus. And Jerome Powell's tenure at the Fed, he's the current chairman, may well be coming to an end. And if that happens, you can only imagine just how dovish the next occupant of that office will be. I mean, after all, Janet Yellen is now Treasury Secretary. She was Jerome's predecessor at the Fed. She's been famously dovish her whole life. I mean, she's so dovish she coos. Right. And Biden himself trying to get these huge stimulus packages through. The last thing you want is a Fed getting even marginally more hawkish. So I think it is unlikely the Fed is going to lead the way in this rate hiking cycle. And indeed, if anyone's going to lead it, it's Eastern Europe, where they don't have the constraint of being part of the Euro system. They can set their own monetary policy. And they acutely feel the inflationary pressure because they're associated with the German economy, which of course has been quite strong in recent years. So Eastern Europe is where you're getting your rate rises.
That's interesting. But John, you said something there I'd like to expand on a bit. When you're talking of Jerome Powell and he may be on the way out, we've got to dive into that a bit further. What do you think might happen here that might see the chair of the Fed abdicate maybe a little early?
Well, look, I mean, he might also decide it's a good time to leave the scene. I mean, it's kind of a poisoned chalice right now, being a central banker, because no central banker likes to face a surging inflation, and no central banker in particular likes to face surging inflation amidst weak growth, which is exactly the mix the U.S. appears to have. That is the classic stagflation. Leading indicators in the U.S. suggest that growth is coming off very rapidly, and yet inflation is at a generational high. If that isn't stagflation, then what is? So maybe it is time for him to leave the scene. He's had a long and, from the perspective of mainstream finance, a very distinguished career now. And maybe it's time for him to go. Keep in mind, also, by the way, it's worth pointing out that there's no implied disgrace in being a one-term Fed chairman. Paul Volcker was a one-term Fed chairman, and he's legendary. So if Powell leaves the scene now, perhaps he can claim a little bit of credit for what he did during his one term and leave pass the poison chalice on to the next poor sod who comes along.
Yeah, I believe it was our mutual friend Grant Williams who described who described the role of being, made chairman of the Federal Reserve. And this was a few years ago when Jerome Powell arrived as a hospital pass for all of the rugby fans who may be watching this, which is when somebody throws the ball to you in rugby when they know that you're about to get tackled. So when you receive a hospital pass, you're about to get wrecked, really. So I think it is interesting to see, to make the comparison between, Volcker being a one-term Fed chairman. But John, Volcker left after, after a big bang, right? He'd made a huge impact on the entire world, let alone just the US, by throttling inflation, strangling it with high interest rates. Do you think Powell might do something rash before he decides to exit the scene?
It's unusual for a departing Fed chairman to do anything controversial. That almost never happens. What Volcker did that was controversial was done very early in his tenure, right, in his term. So I think it's unlikely that Powell does something to rock the boat suddenly. Now, that said, if he's reappointed to a second term, something which obviously could happen, he may decide that if there is going to be a time to try and get on with it and rebuild a bit of the Fed's credibility, he should get on with it pretty much straight away. So I think that it's more likely if he's reappointed that that you do get a hike, even though that any hike that is done, I think, would be very, very small. I think there's an implicit deal that the Fed has to support the stimulus packages that are being put together now. So if there is something done, it will be a symbolic move to reestablish a bit of credibility, but it won't meaningfully impact the financial conditions of the United States.
Right, right. Now, going back to the Bank of England, we do get a question here from P. Lewis, maybe that's P. Lewis, and forgive me if I'm wrong, who asks, how high do you think the Bank of England could raise rates in the medium term? I think this is a very good question in terms of just how when you're actually thinking of what the Bank of England might actually do if they do mean to raise interest rates. How high do you think they could raise them, John?
Well, I think that sadly, because of legacy debt and leverage issues, and also some structural problems in the UK economy, I don't think the UK economy can survive positive real interest rates for any sustained period of time. And what that means is if inflation is creeping higher, it's just above 3% now, but let's say it creeps higher still, which again, the pipeline pressure suggests it will. I think we're going to peak at least somewhere north of 4, possibly 5, before things begin to level out a bit. Well, that would mean, of course, that the Bank of England, in theory, could be raising interest rates to this sort of level, 3, 4, 5%, and real interest rates would still be negative slightly, or at perhaps 0. But I think that is the absolute limit that we could possibly expect. I don't think there's any way in this cycle that interest rates real interest rates are going to move back into positive territory. They'll kill the economy, and so I think it's much more realistic to think that what the Bank of England will choose to do from this point forward is simply try to keep real interest rates slightly negative, which implies that monetary conditions are still very, very accommodating. So if inflation is getting to 4 to 5%, maybe at that point they've raised rates to 1 or 2%. You still have meaningfully negative real interest rates, but you can claim as a credibility building exercise that nominal interest rates are at least beginning to normalize, right? That term that central bankers toss around now and again.
Yeah, we're doing our job effectively. So we're raising interest rates a little bit, but we're keeping it below inflation and allowing the inflation to destroy a lot of the debt that everyone's been worrying about for quite a while. It does seem to me, if I had to gamble on it, that would be the plan of action. If I was Andrew Bailey, that would be what I'd be doing, was just raising interest rates a little bit. And making sure that you are behind the curve on inflation, allowing the inflation to destroy a load of the debt, which is going to get the government on side with you to some degree, but you're giving the appearance that you're a fine, upstanding member of the Bank of England's tradition of safeguarding monetary sovereignty, etc., etc. We do have plenty of questions on this. It is great to see the chat getting quite so lively. On the topic of real interest rates, John, because as of course gold and real interest rates are very tightly wound together, or inversely at least. So when real interest rates go down, gold generally does quite well. Do get a few questions here on, is it a good time to buy gold? Now, of course, we can't give financial advice on this, but just in terms of the environment that the Bank of England now finds itself in, and the gold price in general, in sterling terms, what do you think this does for the gold price? Because as you say, you don't think that the Bank of England is going to be able to raise rates to a real level, above inflation in the medium term, really, and not for a very long period of time. So what do you think this does to the gold price?
Well, I mean, obviously, the gold price in theory should remain in a general uptrend as long as real interest rates remain zero or negative. That's what the historical data tells you very, very clearly. That's not a month-to-month prediction, but it is certainly kind of a sort of a year-to-year, sort of slightly longer term, very, very solid relationship. And it's increasingly curious in my mind, and I'm not alone, that the gold price has not done better this year, given that real interest rates have fallen quite significantly now. And it's becoming a real head scratcher. Earlier in the year, my explanation for that was that because the stock market and other risky assets were still doing so well and in such clear uptrends, that there was this risk proclivity in the market, which historically is a brake on the gold price, because gold is a safe haven, of course. And if people are inclined to take risk, then they're not bothered about gold at any level of interest rates. However, more recently, the stock market has been materially weaker, and yet gold has yet to react in any meaningful way. That is curious. Now, what is also curious is how well crypto is doing. It's not just Bitcoin, right? It's the whole crypto complex. And it almost does make me wonder if at the margin, and I stress at the margin, I don't think this is the main driver here, crypto is sucking some of the natural traditional demand for gold away into its own space. And there are understandable reasons for that. There is a lot of hype. Crypto has been doing very, very well. You have this new ETF now trading in the United States. So that could be a small piece of the puzzle, but I stress small. I think the bigger picture here looks increasingly curious. And I actually think gold's a screaming buy here. Again, this is not investment advice per se, but that based on my own models, based on my own historical reasoning, I think gold is underpriced by an order of magnitude practically at this point.
Right. I do agree with you, John. If it is occurring that Bitcoin is stealing some of gold's thunder, or the crypto complex as a whole is stealing some gold's thunder, I do think it does need to be occurring at the very margins. Because even if we take into account this ETF, this new ETF in the States, when you're looking at the total flows into exchange traded products, all of the crypto exchange traded products in the world. So, while the US has only just approved one, there are plenty in Canada and several other countries have listed these products that have allowed mainstream institutional investors, etc., to get exposure to the Bitcoin price. Look at the flows into those products. It's not huge. I mean, there was a big surge at the beginning of the year and at the end of last year, but right now there's not. I think it's more. I'm sure there is some at the very margin. Of course, there are plenty of the everyman who thinks maybe Bitcoin's a better version of gold. But in terms of when we talk about big, broad investment flows, I do think it must be at the very margin. But actually, John, this does tie into something. John, in terms of this new Bitcoin ETF that they've finally allowed, it doesn't actually hold a real Bitcoin. It only holds Bitcoin futures. What's your take on this event? Do you think it's a big signpost of what's to come? Do you think they're not going to allow a real Bitcoin ETF in the future? Is this sort of a halfway house? What's going on?
Well, Bitcoin is a difficult one in this case because it still is essentially unregulated. And everyone kind of knows that at some point, some combination of the SEC, the CFTC, and of course, other non-US regulators are going to try to put some structure around it. And so this ETF, this new one in the US, it's taking the safe route of using a future which trades on a regulated US exchange. And by doing that, instead of directly holding Bitcoin, which is unregulated, they're kind of positioned already for a world in which the SEC and or CFTC have moved and taken some sort of action, which might make it impossible or illegal for ETFs to hold Bitcoin directly. And so I think that may be sort of why they're doing it the way they're doing it, a cautious regulatory approach, one that they think will not invite unwanted regulatory scrutiny in future. Now that said, this goes then back to something that I've discussed on multiple occasions, and which actually doesn't win me any friends in the crypto community, which is that the practical reality of the way Bitcoin and other crypto trades, the structure of it, it's not as decentralized as it in theory was designed to be. I mean, Bitcoin by design is as decentralized as it gets, but the practical reality of using exchanges, of potentially reducing transactions costs and friction by using Lightning, um, using futures as a derivative, using an ETF collateralized with futures as a derivative. These all represent points of failure. They all represent forms of centralization that can be regulated and can be regulated out of existence if that's what the regulators choose to do.
Yeah.
So the practical reality of the way crypto is evolving is not in keeping with this decentralized ethos as much as the original designers would have it. And that's a challenge. And it's not a challenge that's going to go away. More power to those who find a way to retain the decentralized benefits of digital, alternative digital currencies, be they proof of work, proof of stake, whatever it is. More power to those people who find ways to retain the benefits of decentralization, but nevertheless navigate this looming regulatory, sort of Damocles that at some point is going to fall.
Yeah, there is plenty we could expand on in that. There have been many theories with why the US has behaved the way it is around Bitcoin with the ETF, things like that. Maybe we'll have time to return to them at the end, but we do have so many more questions. I would like to run through a few. This is going back to inflation and the Bank of England. Gareth asks, is it a good time for my daughter to get a mortgage? Well, Gareth, we can't give quite such specific advice on this show, but in terms of real estate, John, and interest rates, of course, if you're really big into real estate, you quite like your a bit of inflation here and there. You can borrow, especially when interest rates are below the rate of inflation, as we expect. So you can borrow quite cheaply, and then as you pay off your mortgage, the inflation removes the value of the debt, and you end up with a house and a very small amount of debt to pay. On that note, what do you think the outlook is for real estate? Just residential real estate in the UK. If as we expect, the Bank of England does not raise interest rates very aggressively and allows inflation to get ahead of them.
Well, I think kind of ordinary residential real estate in the UK is probably a
reasonable bet, even though even though valuations are high in a historical comparison. Look, if you can take out a mortgage at sub 1%, which apparently, I know some people who claim to have sub 1% mortgages. If you can do that when inflation is running 3, 4, 5, then yes, the Bank of England is paying you they're paying for your house, right? They're paying your mortgage, and there's no reason in principle not to take advantage of that. Now that said, I think pockets of prime property are in trouble. I don't know if city centers are going to survive what lockdown has done to this economy. And for all we know, there's another lockdown coming. But I think sort of plain vanilla residential real estate is probably a safe bet, a reasonably safe bet in terms of holding its value at least, right? You certainly don't want to be in government bonds now, God forbid. So that is something that I think is reasonable. And oddly enough, though, this bizarre situation of literally having the bank pay you to buy a house, service your mortgage for you, reminds me when I arrived in the city in 1998. I had some colleagues who had mortgages, but they had mortgages denominated in yen because that was a popular product at the time. Buy a house in the UK, finance it in yen. Why would you do that? Well, because in 1998, Japanese interest rates were already about zero. So in that situation, right, you got the Bank of Japan to buy your house for you. How nice is that? I know it's a crazy, crazy world, right? Zero interest rates, negative real interest rates, whatever it is. So, but yes, there's no reason not to take advantage of that, in my opinion.
Yeah, I remember back when I was a financial advisor, this is back in 2016, there was one there was one mortgage product that you could sell, which was below 1%. Below 1%, I think it was fixed for 3 years. I think it was 0.75 or 0.95. I think it was the Halifax that offered it, but it was very, very niche, and everyone was like, "Wow, this has to be the bottom in interest rates. They can't go any lower than this." But maybe these days, I'm checking the market. Maybe these days you can get something similar. Gareth, I hope we have answered your question there. Another question. This is taking sort of the other side of the interest rate question, which is regarding pensions. When you're looking at bonds and how much bonds that pensions hold, will interest rate increases benefit potential pension rates, or pension rates drop the Bank of England if the Bank of England increases interest rates? That's from Doug. I believe I guess we're talking a bit about annuities at this point when it comes to inflation. What would be your take on that, John? When you're looking at how much pensions need real interest rates, they need some kind of positive interest rate in order to make some returns. Do you think that what the Bank of England does, if we do as they expect and they do keep interest rates below the rate of inflation, this should put a lot of pension funds into a bit of a tight situation, right?
Well, look, I mean, pensions have been in a tight situation for years because they have liabilities, which are long dated liabilities, and the trend over decades now has been for long-term interest rates to decline. And so the ability to offer reasonable rates of return on those policies has just become more and more difficult. And of course, what that does is that encourages pension funds to take risks they wouldn't otherwise take to try and still deliver the sorts of returns that their pension holders expect. Now, that said, there are regulations that strictly prohibit pensions from taking certain types of risk, and they have to do a certain amount of so-called asset liability matching to make sure that there's not going to be some huge miss when the payout comes due. And that's quite a complex sort of complex art, as it were. But around the margins, right, pensions end up taking perhaps a bit more risk than they really should. It makes pensions' lives a lot easier if real interest rates are at a reasonable level, so they can just put a bunch of cash into fairly safe bonds, be they government or corporate, and let it achieve some reasonable compounded rate of return over time, such that when the life insurance comes due, such that when whatever form of insurance it is comes due, or the pension itself needs to be paid out, et cetera, they can meet those obligations. So in a way, I guess at the margin, pensions would welcome higher interest rates. But if they're taking risk and risky assets, and those assets crash as a result of the Bank of England hiking interest rates, then what they make up on the one hand, they lose on the other. I mean, it's one of those things, right? You wouldn't want to start from here as a pension fund.
Yes, there are plenty of hard questions. Being a pension fund, especially if you're one of the the custodians of a defined benefit pension fund, where the liability on providing a guaranteed return is on your shoulders. You can't just say, oh well, just stick with a defined contribution pension fund, and what you can pick your own funds, and whatever happens, it's on your head, be it. If you're running one of these defined benefit funds, now must be quite a. The challenge, of course, must be quite enticing to many investors. Who want to figure out a way of actually sort of untangling this Gordian knot we found ourselves in. But it must be really very stressful, I think, for a lot of those, and even more so for the trustees who hope that that their returns will be preserved and guaranteed. Of course, the government does provide a certain level of a guarantee for defined benefit funds, but at the same time, it is a very tricky situation. Now, an interesting question here from Imran, who asks, what use will gold have in a digital economy? Now, just earlier today, I saw one of the hardcore Bitcoiners, really rabid, foaming at the mouth, saying that what Bitcoin is going to do is going to unlock gold's role as an industrial metal, by which he meant that Bitcoin is going to steal so much of gold's thunder that we're going to be able to use gold for knives and forks and things like that, or for I don't know, making certain car parts and stuff like that. And to me, it was just a great example of just how I think some people get carried away with what gold has become an asset of the past and how it's not going to play a role at all in the future. But Imran, John, let's answer Imran's question. What use will gold have in a digital economy?
Well, look, I mean, it depends really on what you mean by digital economy, right? Because we can have a digital currency, which is in fact fractional token claims on gold. You can have digital gold, and in fact, there are several firms that offer a product which is essentially that tradable, tokenized digital gold. And so you don't have to have a Bitcoin style cryptocurrency, which is simply backed by, well, electricity, basically, right? You can have one that is in fact backed by gold or backed by silver. I know of one firm that's thinking about doing a silver token. Okay, so that, I mean, it really depends on what you mean by digital economy. Now, that said, if indeed for whatever reason in future society does decide to adopt something like Bitcoin, which is backed by, again, electrical power, I guess, then what role will gold have? Well, I mean, there's natural demand for gold all over the world, notwithstanding the fact that it's not legal tender anywhere. And none of that demand is going to go away at all. So yeah, there's always going to be a bid for gold, right? And this is one criticism that I don't normally make with respect to Bitcoin or the crypto community more generally, but I've heard it made, and I do have some sympathy for it, and it's the following. The price of gold does not go to zero. And it doesn't go to zero because there is always going to be some residual bid for jewelry or other beautiful items of this non-corroding, non-reacting, eternal metal, which, I mean, it almost co-evolved with human civilization in terms of its uses in religion, in art, and so on and so forth. That's just not going to go away as long as human nature is what human nature is. Whereas I can imagine a situation in which one or more cryptocurrencies, for whatever reason, possibly Bitcoin itself, go to zero. They fail to gain sufficient acceptance. The amount of computing power required to maintain the network is excessive, and adequate solutions are never found to try and maintain that network at reasonable cost. That I can imagine. I'm not predicting that. I can imagine that. I can't imagine the bid for gold going to zero.
Yes, I would agree. I would agree with most of that. I think for Bitcoin and for the crypto space in general, we haven't had something akin to a cyber 9/11 yet, where internet usage, actually is impossible. In which case, and if that does happen, even if it's for a short period of time, I mean, there simply can be no bid for all these crypto exchanges. Of course, that is the same for a lot of more as it would be called in the crypto community in TradFi and traditional finance. It's not like the stock market's going to be trading very easily in an event where the internet's not working. However, I think we are at some point going to see something like a cyber 9/11. I remember that this was a phrase that we used by, I believe it was Chief Operations Officer at BlackBerry, which has since become a cybersecurity company, saying we've yet to see cyber 9/11. And of course, he's talking his book to some degree because he's working in cybersecurity. However, one does have to wonder when, in a digital economy, when we all rely so much on the internet, what happens when somebody switches off? Because it's a tool of war now to be able to turn the internet on and off, and somebody is probably going to try it because it's a lot easier than well, it's not. Some of the ramifications of it are not quite the same as things like troop movements and rolling tanks around and things like that. But it is a very good question, Imran. Thank you for that. What use will gold have in a digital economy? I guess probably to turn it around, I would probably say that a lot of folks in the crypto community, especially those who've made a decent bag for themselves, do have a huge affinity, I've found, for gold Rolexes. So I think that is certainly a use for gold in a digital economy. People still like flexing on each other with some swag watches. But carrying on with some of the comments here. Interestingly, so Alwyn comments: if gold is useless, why did China stock up on gold? They're trying to back the yuan with gold in their currency wars to knock the USD off as the world's reserve currency. On that, John, on Alwyn's point there, do you think, what's your take on what China is doing with gold and with its dollars at the moment? Because we don't have to go as hardcore as saying China's going to back the renminbi with gold. But in terms of what China's up to, and I believe I saw a headline the other day regarding the sale of some dollar bonds there. What's your take on that? Is there any new updates on what China's doing with gold?
Well, as best I can tell, China's doing what it's been doing for a long time, which is not only accumulating gold at the public national level, but encouraging the accumulation of gold at the private level. They've got a much more liquid and developed domestic gold market now than they used to have, making it much easier for households to acquire gold. So it's not just the state doing this. Also, you have better trading infrastructure, right? You have listed gold futures now in China,
Yeah.
and you have, of course, a lot of gold production. I mean, it's not generally known that China is the world's largest gold producer because of the western part of the country and also the part that in the north that borders Mongolia does have significant precious metal deposits. So China produces a lot of gold, but it also imports a lot of gold from around the world. And again, some of that ends up in state coffers, some of it ends up in household savings. And this has been going on for a long time. Now, China has never given any indications that it is accumulating gold in the way it's doing as a specific means to diversify its reserves and other assets out of dollars. They've never given those sorts of clear indications. There have been hints, perhaps, but never ever anything very clear. Whereas Russia, which is also a significant gold producer, has very clearly and openly been accumulating gold as a strategic metal, allowing it to diversify not only out of dollar assets, but out of other paper assets more generally. So Russia's farther along, as it were, in terms of gold accumulation, having almost an overt political purpose to give them freedom of action. In particular, if they come under ever stricter sanctions, they'll still be able to use gold to trade. Gold's universally accepted. If you're under sanctions and you can't use dollars, well, use something else, and you can certainly use gold. So you also see Turkey accumulating gold. You see a lot of, I think all of the Central Asian republics accumulating gold. And indeed, you see countries pretty much all over the world accumulating gold at a more elevated pace than they have since Bretton Woods was still in existence. So now there is something going on here, but China's given no indication the way Russia has that they're doing what they're doing specifically as an anti-dollar move. Now, I suspect that it is part of that, but they've never said so. But then the Chinese, they kind of like to play poker in this regard. They're not going to show their hand until they play.
Right. Yeah, they've not gone quite overt with what it is that their strategy is. They don't want to show you what's going on. Just going through the chat again, we do have, we have the comment from Chris actually, which I thought was very good. I started working in 1976. I've seen it all and survived. No need to panic. Well, Chris, thank you very much for the vote of confidence. I hope things are proceeding as well as they had for you back in 1976. And one thing I find interesting with the inflation story is that if you were a young lad who was entering the workforce at a period of high inflation, where as long as the economy was carrying on a bit, inflation could very much work in your favor because you could demand higher wages quite often. And as you were at sort of the beginning of your working career, you didn't have a huge amount of savings that were going to get evaporated. So you could actually use the inflation to your benefit and use it for example, as we've said, getting a mortgage, allowing the inflation to rip up the debt while you end up with a house. And it was quite good, though. Of course, if you were a saver in the 70s, it was a very bad time to be a saver, to have any cash. And I do wonder if we're at a similar phase where millennials feel like they've been given a very poor hand in general with how Lord knows how many recessions now, and how many crises that were only meant to happen once every 100 years, et cetera, et cetera. And I wonder where maybe the inflation will sort of turn the tables on that. One thing I'd like to discuss with you, John, actually, before we carry on with this, that we have carried on for quite a while here, and there were a couple of other topics that we were going to bring up. But there's one thing I'd like to discuss with you, which ties together the gold side of this, and we've been discussing the Bitcoin side, and again with the end of Bretton Woods, the end of the gold standard back in 1970s, and this comes back to futures and how futures can be used to diffuse demand for certain assets. So if we wind back to 1971, when the US was still on the gold standard and it's decided to exit it, interestingly, the State Department, in some of the cables that WikiLeaks dumped many years ago, and there was huge number of these cables, but amongst these were some cables from the State Department back from late 60s, early 70s, where they were concerned that if the US went off the gold standard, or it may even have been when Bretton Woods was becoming under strain. So it might have been before the end of the gold standard. I can't quite remember, forgive me. But effectively, the State Department went to London and went to the big gold dealers in London and were saying, if we stop redeeming dollars for gold, what will happen? Because they wanted to avoid a huge amount of demand for gold, because this would make the US dollar look very bad as the global reserve currency. So the gold dealers allayed their fears by saying, no, don't you worry. As long as we get the futures trading going well enough, all of the demand for gold will simply be diverted into this paper market, and we'll be able to keep things relatively stable in that way. So if we fast forward to today, and we've now seen Bitcoin get its first ETF, and it is backed indeed by futures. And a few years back, I believe this is in 2018, a gentleman who is quite senior within the Trump administration's economic advisory team. I forget whether he was CFTC or if he was SEC. I believe he had a name. It was like Jamborino or something. Sorry if I forget the details, but he said he actually took credit for bursting the Bitcoin bubble. And so what he said was, it was myself and I believe it was Gary Cohen, within senior economic advisor to Donald Trump. We actually saw the Bitcoin bubble occurring, and we deliberately introduced paper futures contracts in order to burst the bubble, because all of the money that was going to Bitcoin, which is of course quite illiquid, went into futures instead, which aren't settled in Bitcoin, and as a result, this killed the demand for Bitcoin. And indeed, when you look at the prices and when you see when paper futures were first introduced for Bitcoin, that pretty much did mark the top, or at least very close to the top of Bitcoin in late 2017. So this is I'm going very roundabout here, but today we have the ETF launched, and it is indeed just backed by futures. It's not backed by Bitcoin. And I wonder whether or not this is a deliberate attempt in order to make sure that any of this institutional money or any of this pension money or any of the money that would have been interested in a Bitcoin ETF doesn't actually end up in increasing demand for Bitcoin and only in demand for Bitcoin paper futures. Instead, John, am I crazy for thinking this way? What's as indeed somebody says in the chat, John says, Boaz, you nutter. Am I indeed crazy for thinking this way, or is this just a load of correlations that they don't have any purchase today?
Okay, well, look, one of the conveniences of futures, right, is that it's just as easy to get short something as it is to get long something. Whereas when there's only the something and not the future on the something, you're either long or you're just neutral, right? There's no way to get short. So a future does invite short interest. Now, it's not clear at all whether the short interest will be sufficient to prevent the long interest carrying the day and maintaining an uptrend, but other factors equal, if you assume there is some skeptical group of investors out there who would love to short something, then yes, by creating a future, you're allowing those people to enter the market in a convenient way for speculation and profit on the downside. However, there are futures and there are futures. Some futures are only cash deliverable, and that's certainly the case with Bitcoin futures. You simply take a reference price based on, some sample of exchanges, I suppose, in the case of Bitcoin. I haven't read the exact contract spec. And then you just cash settle it on the day using dollars. Yep. That is, no physical Bitcoin ever changes hands.
Nope.
And to be fair, there are a number of futures contracts out there that are cash settled. However, traditionally, futures are not necessarily cash settled. That is, you stand for physical delivery. Okay, and this, of course, the modern version of this business, although in some form a futures type business, it actually goes back to the Greeks. I mean, even the ancient Greeks used to have in the marketplaces something that was equivalent to sort of a modern day futures market, if obviously less sophisticated. But the basic concept was there in the agora back in Greek times. Okay, so fine, let's get back to today. But if you take a look along the way at how we got here, the development in Chicago around agricultural futures, that's famously all physically deliverable, right? The pork bellies, right? The wheat, the corn, and so on and so forth. And that's certainly true of precious metals, right? It's true of gold and silver. You can stand for delivery. You have to be registered to do that, but you can stand for delivery. And indeed, on a regular basis, people do that. And what makes a physically delivered futures contract much harder to manipulate in principle is that people can simply stand for physical delivery at any price. They can say, look, I want my metal, or I want my pork bellies, or I want my frozen concentrated orange juice, to use the example from Trading Places,
right?
The film. So, I mean, in the case of the Bitcoin future, because it's cash settled, I mean, yes, I mean, it totally invites potential manipulation, fraud, abuse, nothing that is necessarily tied to what's really going on in the physical, you understand what I'm saying, physical Bitcoin market.
Yeah.
Whereas in principle, gold and silver should be less manipulable because they're physically settled.
Yeah, I do wonder whether or not we're going to see more of that. I guess it depends on whether or not the US allows more Bitcoin ETFs to trade on US exchanges, and whether or not they do allow a spot Bitcoin ETF, an ETF that actually does hold, or at least backed to some degree by Bitcoin, rather than just cash settled. John, we are getting on for time a bit here. We do have there are a few more questions. Al does ask about supply chain disruptions, and we were in fact going to talk a bit more about the energy chaos that's going on, but it will have to wait, I believe, until next week. I do thank all of you who have tuned in tonight. It has been very good, very lively chat as always, which is great to see. We shall carry on with the evening slot for a little while to see if more people like it, see if more people tune in. If you are watching a recording of this, do feel free to give us a like and to subscribe, and indeed to leave any comments regarding questions you'd like us to ask, like me to ask our future guests on this show. But John, thank you so much for joining me this evening.
My pleasure, boss.
And thank you all for those watching for joining us. This has been very good, but that is all for the moment. We'll see you next week.